Hello, YouTube community, and anybody else who might be watching. I first and foremost really wanted to give a deep thank you to Lynn Alden for writing the paper that we're about to work. You can find her at Lynn Alden Contact on Twitter. You can find her work in the Rebel Capitalist Show with George Gammon. You can find some of her articles on Seeking Alpha and a various other amount of places. The paper that we are going to be reading today is titled Banks, Quantitative Easing, and Money Printing. I've been looking for one paper in order to bring everything together and help me understand it. And after reading about a third of this paper yesterday, I think that this might be the one. So, we are going to begin the paper. It's probably going to take about 2 hours to get through. So I appreciate if you stay for part of it. I appreciate if you stay for all of it. I appreciate if you share it. And, make sure to thank Lynn for the work that went into this. Lately, it has become fashionable to debate what is or is not money printing by central banks. This debate is natural due to the extreme policy nature of 2020, with massive fiscal expenditures, huge debt increases, and central bank balance sheets, and changes in central banks' inflation targets. It's important to know what is inflationary and what isn't, and to what extent. Because people have a very different understandings of how central bank policy and fiscal policy work, there have been analyst calls this year ranging from hyperinflation to deep deflation and everything in between. The outcome has of course been somewhere in the middle as measured by the CPI or the PCE, with inflation that rebounded from March lows in response to policy, but neither much of an overshoot or an undershoot, and still generally below long-term central bank inflation targets. Many inflation categories for most essential and non-outsourced goods and services, however, have risen faster than the overall basket this year and in recent years. The crux of this article is that quantitative easing on its own and quantitative easing combined with massive fiscal deficits are two very different situations to consider when it comes to analyzing the possibilities between inflation and deflation and what constitutes money printing. The deflationary backdrop. Historically speaking, we're coming down from the apex of, and currently within, the lengthy resolution process of a long-term debt cycle, which refers to multi-decade peak in public and private debts relative to the size of the economy and money supply. This occurs in the aftermath of when interest rates hit zero. We've been in this resolution process for 12 years, and the previous time before that was the 2-decade period of the 1930s and 1940s, where we hit the previous apex of a long-term debt cycle. Here is total debt as percent of GDP in the United States over the past century. In blue on the left axis, all debts, public and private, along with short-term interest rates in orange on the right axis. So you can see that we're now at about 370% total debt to GDP, and interest rates have been now down at historically low bound of zero. And here is total debt as a percent of the broad money supply, which shows the structural peaks of each cycle even more clearly, since policymakers have more influence over broad money supply than GDP due to shifting monetary velocity. That I may actually slightly disagree here a little bit. So policymakers do have more influence over broad money supply, but I don't know that they have that much influence over broad money supply. And I would state this because, in my position, private lending actually creates most of the broad money supply, not public spending. But I would agree that policymakers can't really just whip up GDP, so. If we break out federal debt from non-federal debt, households, businesses, states' financial leverage, we see two distinct peaks in each long-term cycle. Non-federal debt, orange line, peaks first in a commercial banking crisis, early 30s and late 2000s, meaning the 08-09 crisis, and the federal debt blue line peaks many years later in a sovereign debt crisis, mid-1940s and question mark to the 2020s. So you had here your great financial crisis, where private debt and all things that involves peaked up to 300% of GDP, and then it came back down. Then at that same time, this is when the federal deficits went up and up and up. This is the beginning of QE1. This is probably QE2, probably QE3, QE infinity. Oh, you can't see where I'm marking. Okay, so QE1 would have began around here. Then you might have QE2 here. This was the part through to QE3, and then this is what some call QE infinity, with here being around 300% of when we were in the throes of the 08-09 financial crisis, which was huge, a huge credit bubble. These are key points from Lynn. There are a lot of deflationary forces on consumer prices in the economy. High private debt levels are deflationary, since it makes consumers and businesses financially restrained and risk averse. Agree. Slow population growth and aging demographics are deflationary, since resource demand slows. Mostly agree. Technology is deflationary, since it makes some things cheaper and better. Agree. Wealth concentration into fewer hands is deflationary, since money coalesces rather than circulates. So what Lynn is alluding to here is going to be the velocity of money, which, when we get a view of this, you're going to see. I wish I had more data to back this up, but wealth inequality and wealth concentration has been growing since the 90s. And as that has steadily gotten bigger and bigger and bigger, you can see the velocity of money going down to the nadir of what it's ever been since they were measuring it. Now, I don't know if it'll it doesn't let me go back any further. So if the velocity of money down, this means that it's not circulating through the economy as quickly. This means that the money isn't changing hands. This means that less business would be being done. Commodity oversupply is deflationary, since it cheapens the building blocks we use for everything else. Now, this was a little bit of a contentious position when we were reading it yesterday, and I'm only going to be able to barely speak for oil, and even in my positions here, they're going to be weak at best. But due to the cheap access to the American fracking industry of bank loans via interest rates being down near the zero bound, our shale industry was able to develop even against the backdrop of knowing that it would never be profitable, because it could always roll its debts over into cheaper and cheaper financing. So you can take the oversupply of fracked oil, the fact that there is no carbon taxing or carbon pricing, and then if you add that in with the COVID-19 pandemic, where there is less commercial flight, where there's less travel, where there's less commerce and so forth, that really gets into specifically the oil commodity oversupply. We can debate back and forth, is that true, is it not true, and everything. But if you view it the way that the markets have viewed it, which is just by the price, when we've had oil barrels down around $40 a barrel for a very, very long time, this is where you can point to, at least within oil, a commodity oversupply. Outsourcing is deflationary, since it lowers labor costs of goods and puts downward pressure on domestic wages. I don't think there's any disagreement with this. And this is why some people will be saying that as you begin to decouple, decoupling is inflationary. So decoupling means breaking down the global supply chain system and trying to do more domestic sourcing of your goods and your manufacturing. So if you bring manufacturing back from lower wage paid nations into the higher wage demand nations, then the cost of goods is going to rise. However, the outsourcing that's been done during the corporate shift into specifically the Asiatic countries has been deflationary. In a low-debt system, structural deflation for some of the positive reasons, such as technological improvement, would be a good thing. It means your money's purchasing power grows over time, as higher productivity from technological enhancements lowers the cost of goods or improves their quality, so you get more value for your dollar. However, in an extraordinarily high debt system, which requires a lot of central policy intervention in the first place to be able to get up that high, deflation breaks things and results in widespread defaults because the cost of servicing debts goes up relative to cash flows. So fiscal and monetary policymakers deliberately push back on deflationary forces with inflationary policy, especially when it gets to those extremes. And there are a few definitions or types of inflation that we can identify. Monetary inflation refers to the growth of the broad money supply, which can be calculated in a few ways but is pretty straightforward. Asset price inflation refers to bubble-like increases in the prices of financial assets, stocks, bonds, gold, private equity, fine art, and so forth. This is a bit more subjective because valuations on assets can vary, but there are various ratios to keep track of it in a broad sense. Consumer price inflation refers to a broad rise in the prices of everyday goods and services, and people debate about how it should be measured. The government uses the CPI and PCE calculations on a basket of goods, but those use various substitutions. There are alternative calculations that don't use substitutes, which generally lead to higher figures. Each household has their own unique basket of consumer goods and services they buy. For research purposes, I calculated that my personal household consumer price inflation rate averaged about 3% per year over the past 2 years, taking into account our total purchases of non-investment goods and services. Quantitative easing alone equals bank recapitalization. Going into the 2008 crisis, United States banks were extremely leveraged with very low bank reserves. Large bank cash levels equaled just 3% of their assets, blue line below, cash as a percentage of total assets, and large bank holdings of treasuries as a percentage of assets were pretty low historically as well, red line, treasury securities as a percent of total assets. Okay, so you have over here a 1985 graph where banks had approximately 10% of assets held as cash. And that line went down and down and down and down and down and down to a nadir of 3% in 2008. So this meant that they were leveraging their book more and more. So this means that back here, they were at approximately maybe, I guess if you add up the two of them here, you're looking at about 13-to-1 leverage ratio. However, when you get down to here, you're getting to about a 30-to-1 leverage ratio. And you can also see on the red line, which would be the treasuries that they were holding, the treasuries did go up from after the dot-com bubble burst, but then it started to go back down again. So you have low cash reserves and low treasury reserves, both at the same time the global financial meltdown happened. And then here is QE1, here is QE2, here is QE3, here is the repo spike, which I don't know if the paper is going to get into it all, but this was when the overnight interbank lending rate skyrocketed from around 2% up to like 9.5% in September of 2019, when the Fed had to inject around $1 trillion of liquidity into the bank reserves to ensure overnight bank funding wouldn't seize up. And then you have the QE infinity, as which most people are calling it at the moment now. A few times throughout reading this paper today, everybody, I am going to refer back to Lynn Alden's Twitter. The author of this very well-written paper is at Lynn Alden Contact. You can also find her work at lynnalden.com. You can sign up for her free newsletter. She also just wrote a paper that I'll be reading called The 7 Misconceptions About Bitcoin. And as you all can see, when Lynn writes a paper, it's not just a 60-word piece. They are very long papers. So I thank you so much for making this work available to the public, and I really appreciate that you're writing it in a way that we can all understand. So leading into the financial crisis, only about 13% of their assets consisted of cash, 3%, and treasury securities, 10%. The rest of their assets were invested in loans and riskier securities. This was also at a time when household debt to GDP reached a record high as consumers were caught up in the housing bubble. The over-leveraged bank situation hit a climax in the 2008-09 crisis, coinciding with a record high debt to GDP among households, and was the apex of the long-term private non-federal debt cycle. When banks are that leveraged with very little cash reserves, even a 3% loss in assets results in insolvency. And that's what happened. The banking system as a whole hit a peak total loan charge-off rate of over 3%, and it resulted in a widespread banking crisis. However, banks were bailed out via quantitative easing and the Troubled Asset Relief Program, known by most of us as the Toxic Asset Relief Program. It was a top-down, anti-deflationary bank industry bailout, not a bottom-up, pro-inflationary, real economy bailout. TARP boosted bank solvency, and quantitative easing boosted bank liquidity. As the crisis played out and some banks failed and others were bailed, regulators wanted to increase bank reserve requirements and capital requirements, requiring banks to hold a greater percent of their assets in cash reserves and other safe assets. The problem with that, however, is that banks can't just magically boost their reserves. They would have to sell other assets to get cash, but if every bank in the system sells assets to get cash, who do they sell to? And where would so much cash come from to buy what they sell? In other words, while it's possible for an individual bank to boost its reserves by selling assets to raise capital, it's mechanically impossible for the entire banking industry to collectively raise its reserves industry-wide. So, in the role of lender buyer of last resort, the Federal Reserve created new cash reserves out of thin air, gave them to the banks, and took some of their treasuries and mortgage-backed securities in return, aka quantitative easing, or QE. Along with TARP, this recapitalized banks, bringing them from 3% cash as percent of assets at the start of 2008 to 8% by the end of 2008. The Fed did further rounds of QE through 2014 that brought banks collectively up to 15% cash levels, which brought them up to frothy levels of excess reserves. This, however, didn't result in more money chasing fewer goods and services, and therefore wasn't particularly inflationary for every prices. The money remained mostly internal to the banking system, at higher reserve levels. broad money supply didn't increase rapidly. I'm going to reread this paragraph. This, however, didn't result in more money chasing fewer goods and services, and therefore wasn't particularly inflationary for all prices. The money remained mostly internal to the banking system at higher reserve levels. Broad money supply didn't increase rapidly. Most analysts that were worried about inflation missed the fact that the transmission mechanism from QE to the real economy was small. So this was mostly just a bank recapitalization process. Banks and their executives got a nice assist from the Fed and Treasury, but the broad public did not. Banks didn't lend much of the money out, nor was there a ton of creditworthy demand for them to do so, and fiscal spending didn't go around the banking channel very much either. A similar version of this played out in the 1930s, which was the previous time that interest rates hit the zero bound at the apex of a long-term private debt cycle. The banking system collapsed back then too, so policymakers devalued the dollar versus the gold peg, expanded the monetary base, and recapitalized the banks during a banking holiday. This was enough to offset the deep inflation that was happening in the early 1930s and turn it back into a reflationary trend in the mid-1930s, but not enough to cause rapid, broad consumer price inflation. It was anti-deflationary, in other words, but not outright inflationary. The inflation fake-out. All told, the Fed expanded their balance sheet by about $3.5 trillion from mid-2008 to the end of 2014. They created new bank reserves to buy treasuries and mortgage-backed securities. Many folks thought this would be hyperinflationary, Weimar Republic style, so they bid up the price of gold rather high. And here we get some humor from Lynn. I'm glad they felt that way, because I sold my gold to them in 2011 during a period of very high sentiment. It's the only time I sold physical bullion. I wanted to load up on historically cheap stocks instead. Here was the gold price relative to my model, orange area way above blue line. Now some of Lynn's charts here, you've got a much bigger brain than I do. You've got data degrees and I don't. I don't exactly understand these. Maybe the YouTube community does. But I'm mostly just going to have to take the L here and say, Of course, this QE ended up not being outright inflationary for consumer prices for reasons described before. It was anti-deflationary rather than outright inflationary. Along with low rates, it was somewhat inflationary for asset prices, but not most consumer prices. That's how it worked in the 1930s, too. We can put some broad numbers on it. From 2007 to 2009, there was an $11 trillion decline in United States household net worth, as it fell from $71 trillion to $60 trillion, due to a decline in stock and house prices. It then took about 5 years for the United States household net worth to recover to previous highs. This was $11 trillion in deflationary wealth destruction, plus technology improvements commodity oversupply, tightened credit for home equity loans, and other deflationary forces, up against the response of $3.5 trillion in Fed Bank Reserve Creation, or QE. Of course, it wouldn't be hyperinflationary. Morally hazardous? Sure. Hyperinflationary? No. Moreover, as previously described, most of the $3.5 trillion never entered the broad money supply because there was no major fiscal transfer mechanism, so it mostly just stayed in bank reserves. It offset a deflationary shock and bank collapse by recapitalizing the banking system with higher levels of solvency and liquidity, and thus was anti-deflationary, but it was not outright inflationary. Bank reserve example. Banks, in practice, are limited in how much leverage and risk they can take by their regulatory capital requirements. In this model, there are some very low-risk assets like bank reserves, treasury securities, and gold that don't count against the bank's risk level, and there are higher risk assets, personal loans, corporate bonds, that do count against a bank's overall risk level. Banks need to maintain an appropriate balance of assets to avoid being considered too risk-heavy. In some regulation regimes, banks can also be constrained by reserve requirements, meaning that banks are required to have a certain percentage of deposits stored as cash reserves. Suppose there is a regulatory rule which says that all banks must have an amount of cash equal to 5% of their customer bank deposits, which are liabilities for banks owed to their customers held in reserve at the Federal Reserve. So, if a bank has $100 billion in customer bank deposits held with them, which are liabilities for the bank, and $110 billion in assets, and so they have $10 billion more assets than liabilities, they can put up to $105 billion of their assets into various forms, loans, securities, corporate bonds, etc., but must hold at least $5 billion in cash reserves at their account with the Fed. Here is a reserve-constrained bank example. A bank has $100 billion in deposits, liabilities, and $110 billion in assets. Of their assets, $5 billion are in cash reserves, $20 billion in treasuries, $10 billion in mortgage-backed securities, and $75 billion in other assets, personal loans, mortgage loans, corporate loans, or whatever else. This bank can't lend any more until it either collects more deposits, which would also boost reserves, or sells existing assets. It is therefore reserve constrained. It might want to lend and has good client demand to lend money to, but it cannot leverage itself anymore. If the Fed were to create $5 billion in brand new reserves, aka QE, and buy $5 billion of their treasuries or mortgage-backed securities, it would alleviate their reserve constrained status, and the bank could use that $5 billion to lend more or buy more securities. This would be economically stimulative if the bank wants to lend money, because now the bank can go ahead and lend that money and thus create deposits somewhere in the system and increase the broad money supply. Here is a non-reserve constrained example. A bank has $100 billion in deposits, liabilities, and $110 billion in total assets. Of the assets, $15 billion is in cash reserves, $20 billion in treasuries, $10 billion in mortgage-backed securities, and $65 billion in other assets. The bank has $10 billion in excess reserves above the $5 billion requirement. Extra money it can lend. Maybe it doesn't want to lend right now. It doesn't see any good risk-adjusted loans to make. Or there isn't a lot of demand from its clients to borrow money. So it's just holding that extra $10 billion as excess reserves, in addition to their $5 billion required reserves. If the Fed were to do QE and buy $5 billion of their treasuries and bring the bank up to $20 billion in reserves, it won't affect how much they lend because they weren't reserve constrained to begin with. This would not be stimulative and would not increase the broad money supply, since it doesn't coerce the bank to make any more loans. This is why QE alone is not inflationary. Increasing bank reserves does not necessarily increase the broad money supply. A rapidly increasing broad money supply, along with constraints on the supply of goods and services, is what can lead to inflation. I'll repeat. This is why QE alone isn't inflationary. Increasing bank reserves does not necessarily increase the broad money supply. A rapidly increasing broad money supply, along with constraints on the supply of goods and services, is what can lead to inflation. There are two ways to increase the broad money supply. Either banks need to lend, or the federal government can go around them and run big fiscal deficits. At the apex of a long-term debt cycle, the latter tends to happen. Once again, thank you, twitter.com/Lynn Alden Contact, for writing this paper, and you can find Lynn's work at lynnalden.com. Quantitative easing plus fiscal stimulus equals money printing. Now, in 2020, in the next recession 12 years after the 2008 banking crisis, we're back at it and bigger than before, but with a twist. This time, going into the crisis, the banking system was already well capitalized. The percent of bank assets that consists of cash and treasuries was already historically high. So unlike 2008, banks were not over-leveraged. However, the broader economy was over-leveraged, and the pandemic hit the broader economy. I don't know if I agree with this line. Lynn, the banking system was already well capitalized. I think that it was well capitalized, but my question to you would be, was it still well capitalized during the stock market crash of March, when everybody was trying to liquidate their treasuries? So I think that going into the collapse of the equities markets and the international market, I think that they were well capped. But my question would be, were they still well capped while everything crashed, when there was a run to liquidity and an attempted exit out of Treasury securities? So I don't know if I completely agree here. Millions of people became unemployed, and countless businesses faced insolvency risk as their cash flows collapsed. For the Fed to simply buy treasuries and mortgage-backed securities from banks, and MBS from banks would do almost nothing for this, because it's not a bank recapitalization issue, and there would be no transmission mechanism to the public. Banks were already well capitalized, and so the banks were not reserve constrained. Instead, fiscal authorities, Congress, and the president spent trillions of dollars into the real non-bank economy, sending folks stimulus checks, boosting unemployment benefits by $600 a week, financing banks to give small business PPP loans, that mostly turned into grants, and partially bailing out some of the hardest hit corporate industries with fresh capital injections. It was a much larger stimulus than anything from 08-09. The way that the government's accounting works in the current legal structure is that they have to issue a lot of treasuries to fund that expenditure. This is important. The way that the government's accounting works in the current legal structure is that they have to issue a lot of treasury securities to fund that expenditure. However, the foreign sector was not really buying treasuries, and in fact were selling some treasuries early this year. So who would be able to buy the $3 trillion in extra treasury securities this year? Enter the Fed again. When the treasury market became illiquid in March, which was kind of what I was talking about during the equities sell-off. I didn't say the treasuries market, but when the treasury market became illiquid in March from foreigners and hedge fund managers selling treasuries against a backdrop of insufficient buyers, the Fed stepped in and created $1 trillion in brand new bank reserves out of thin air to buy $1 trillion in treasuries over a 3-week period. This was the most rapid asset purchase program the Fed has ever done. And then they tapered that rate, but kept buying treasuries for months to soak up the massive 2020 treasury issuance that funded all the stimulus, and are still buying tens of billions of dollars of treasuries monthly with newly created bank reserves to this day. So the Fed once again increased its balance sheet, this time by nearly $3 trillion in 3 months, to buy a large chunk of treasuries, plus some other assets like mortgage-backed securities and a handful of corporate bonds. About $2 trillion, or 2/3 of the 2020 balance sheet expansion so far, consisted of buying treasuries. But what made this one different was that it didn't just stay in the banking system to recapitalize the banks. It flowed through banks to the United States Treasury Department, which injected that money directly into the economy as authorized by Congress's CARES Act. The following chart shows the year-over-year change in billions of dollars of total United States commercial bank deposits in blue and government transfer payments in green, and the Fed's balance sheet in red. Okay, so commercial bank deposits, blue. Government transfer payments, green. Fed balance sheet, red. Okay, so I think the reason that the red graph goes to 0 at times is not that the Fed balance sheet went down to 0, but that it wasn't doing any more QE. So in red here, you have the first quantitative easing, which was around 1.2 trillion. Then you have your second QE. Then you have your third QE. These were all just putting money into the reserve accounts of the commercial banks. So all of this red went into this blue line. All of this red went into this blue line. All of this red went into this blue line. Here was quantitative tightening. So from 2018 to fall of 2019, the Fed was somewhat trying to unwind its balance sheet. My opinion is that as it tried to unwind the balance sheet, okay, when you do quantitative easing the old way, if I am the Fed and you are a commercial bank, I give you bank reserves, you give me treasuries. In order to do quantitative tightening, we do the opposite. So I take your bank reserves and give you the treasuries back. And when that happened, in my opinion, this is why the overnight repo markets seized up, because the Fed took reserves out of the commercial banking system at too fast a rate that it actually lowered the amount of reserves that they had and led to a spike in the overnight rates. Now, what Lynn is saying is the QE red plus fiscal stimulus green, in addition to commercial banking deposits, has been different this time because it's actually increasing the amount of money that the government is transferring out to the citizenry or the private sector. And it's not just staying in the commercial banking sector. This chart is critical to see why 2020 and 2008 were quite different, and why the policy response acted so much quicker and more powerfully on financial markets and personal income this time. Personal income and net worth on a nationwide scale went up rather than down in 2020 so far. In 08 to 14, there was a lot of QE, red line go up, but those dollars did not, I'll repeat, did not get out into public bank deposits, which is what mostly makes up the broad money supply. This was because there was little or no fiscal transmission mechanism. The government wasn't sending huge checks to people, so the green line, year-over-year change in government transfer payments, and blue line, year-over-year change in bank deposits, remained low. The QE process in 08 mostly just recapitalized the banks. However, 2020 was a very different story. The government sent out tons of money directly into the economy and financed it by issuing treasury bonds that the Federal Reserve created new bank reserves to buy. I'm going to repeat this part. The government sent out tons of money directly into the economy and financed it by issuing treasury bonds that the Federal Reserve created for new bank reserves to buy. For legal reasons, the Fed buys those securities on the secondary market, but that does not make much of a difference in practice. It's where they end up and remain that matters. The banks that buy them from the Treasury and sell them to the Fed just act as pass-through entities in this case. So, the blue, green, and red lines all went vertical in 2020. Unlike the 08 to 14 period, the government sent money to people and businesses, green line. That money showed up in their bank deposits, blue line, and thus in the broad money supply. And the Fed created new bank reserves to buy a lot of the Treasury securities issued to fund that program, red line. Or put simply, the broad money supply went up a lot in 2020, but didn't budge nearly as much in 2008-2009 in either absolute or percent terms, because quantitative easing alone to recapitalize banks and quantitative easing financed fiscal stimulus into the real economy are two very different situations. So this is the M2 broad money supply that was increasing normally and steadily. However, when you get into 2020, this is where it shoots up to the tune of around 3.5 trillion. Many people who saw the inflationary non-event from 08 to 14 are suggesting that quantitative easing is inherently deflationary and that it won't cause inflation this time either. Again, Lynn throwing the humor in. Sometimes when you write a 2-hour-long article, you gotta drop some bombs about yourself. I'm glad many people feel that way because I'm happy to buy their gold from them on dips. I bought plenty of precious metals back in 2018 and have cooled my purchases since then due to the notable uptick in price, but I'm still happy to dollar cost average into them at these prices or buy on dips. I also like cheap natural resources more broadly, as well as high-quality equities, real estate, Bitcoin, and other scarce assets for a diverse mix with a long-term view. In my view, the quote, QE is deflationary, it only increases bank reserves, end quote, position is from not taking into account the fiscal element, the transmission mechanism that gets quantitative easing into the hands of the public rather than stuck in the banking system. QE alone is not inflationary and mostly stays in bank reserves, but QE combined with fiscal deficits is inflationary and gets the funds out into the broad money supply, out into commercial bank deposits of the public. Basically, massive fiscal spending combined with the central bank buying lots of sovereign bonds to fund it is a modern monetary theory program in practice for the first time since the 1940s when the equivalent of wartime MMT was used. Now, her paragraph here, some people are probably like, okay, from this one, she's calling everything, inflationary at the moment. Her paragraph here is very important to consider along with the 2 paragraphs before. Now, bear in mind that this is still up against large deflationary forces, technology, demographics, debt, and shifting consumer behavior around the pandemic. So even a one-time pro-inflationary $3 trillion injection into the real economy is merely enough to cause a quick rebound in inflation and a sharp recovery in asset prices, as we saw in 2020 from the March lows. Combined with certain supply limitations, it also helped cause a non-discretionary prices to rise. Grocery price inflation in particular was rather significant this year. However, a one-time $3 trillion injection is not enough to cause a persistent trend in inflation. The deflationary forces outweigh it. There is not yet a situation of too much money chasing too few goods and services, except in niche areas. I have some contentions with Lynn here about, she thinks that there was just a recovery in asset prices. I would say it was a reinflation in asset prices to positions that were already inflated. Her and I would be splitting hairs in our little disagreements. Well, actually, we wouldn't be splitting hairs. I mean, I'm more the fire inflation sector of Michael Hudson, of Steve Keen, of Varoufakis, of Blythe, and others. It is a big disagreement between her and I, but it's hard for me to articulate the extent of the disagreement. Okay, so I want to reread this paragraph. However, a one-time $3 trillion injection is not enough to cause a persistent trend change in inflation. those deflationary forces outweigh it. There is not yet a situation of too much money chasing too few goods and services, except in niche areas. The stimulus delayed an insolvency crisis for several months and got consumers through the worst 3 to 4 month period of the economic shutdowns. If we look over the past century, we can see that the two inflationary decades, the 40s and the 70s, occurred when broad money supply rose rapidly. This chart shows the 5-year rolling cumulative price percent increase in the consumer price index and in the broad money supply per capita. So I think blue is monetary supply. Orange is going to be CPI. So during the 30s, when they heavily injected liquidity going into the wartime period, you had high CPI. Then they kind of floated together. They up-peaked during the depegging of gold, which is what helped lead to the inflation of the 70s. Then you have this increase in the money supply, but it's not large compared to what was done prior. It'll be interesting to see if they keep increasing the monetary supply. Therefore, the big question for investors in multiple asset classes is whether the fiscal authorities will keep repeating that on a notable scale or whether they will cool off. Exactly what I just said. If they keep it going, then we'll have to look for more CPI. Without the massive fiscal plus QE de facto MMT combo, the economy remains in the grip of structural disinflation and a renewed cyclical disinflationary trend. However, with another round of massive fiscal plus QE plus quasi-MMT combo, the outcome would likely be more of what we saw in the spring-summer of 2020, rebounding inflation and asset prices, and likely eventually pushing too far. Ultimately, with so much debt in the system and the weight of private debt, policymakers are likely to be forced to do more rounds of fiscal stimulus, either from civil unrest or political donors. But the timing for that... Ultimately, with so much debt in the system and the weight of private debt, policymakers are likely to be forced to do more rounds of fiscal, either from civil unrest or political donors, but the timing for that is something that investors need to work around when it comes to assessing the inflationary or disinflationary outlook for the next quarters ahead. Right now, with money velocity so low and the pandemic still raging, and plenty of commodity oversupply, particularly in regards to oil, it may seem like there is a limitless sink for broad money creation without leading to sustained consumer price inflation. However, that can change a couple years down the line as the world fully emerges from pandemic effects after years of not putting much capital into resource development. It's also worth noting that fiscal stimulus in this sense refers to both spending and taxation. In other words, federal deficits. A fiscal stimulus could include giving everyone a $1,200 check, or could include giving everyone a $1,200 payroll tax cut, for example. The differences between those two mechanisms matter around the margins, particularly for the unemployed, who wouldn't benefit from a payroll tax cut. But for large chunks of the 150 million person working population, which I don't think that there's that many working right now, but a stimulus check and a payroll tax cut are functionally similar throughout the course of the year and result in more cash in the hands of most people. These policies increase the amount of broad money, not just bank reserves. When it comes to fiscal stimulus, regardless of whether it takes the form of taxation or spending changes, its stimulatory impact and inflation outcomes are mostly a question of magnitude, as well as who it primarily targets: unemployed, working class, middle class, wealthy, or rich. It's inflationary against the backdrop of deflationary forces, and so whether the outcome shifts to inflation or remains disinflationary becomes a question of scale and persistence, and whether it increases productive capacity or not. We're about 1/3 of the way through the article. If you want to find Lynn's work, you can go to lynnalden.com. You can sign up for the free newsletter. You can read her articles: 7 Misconceptions About Bitcoin, Banks, QE, and Money Printing, Presidential Elections versus the Economy and Stock Market, A Century of Monetary Policy, Inflation versus Deflation, The Big Tax Shift, 3 Reasons I'm Investing in Bitcoin, 4 Simple Reasons to Buy Gold, Fixing the Debt Problem, Global Opportunities Investment Report, Quantitative Easing, MMT, and Inflation Deflation, a Primer, and more. Or you can follow Lynn at Lynn Alden Contact on Twitter. Catching up with a few comments over here. John McCain's ghost has the answer. Rules are meant to be ... broken ? Or bent ? In my view, focusing on some of the mechanics of the Fed's QE combined with fiscal injections is like focusing on the trees and missing the forest. This is because at the end of a long-term debt cycle, policymakers do whatever they need in order to avoid a deflationary collapse and get towards some degree of reflation and devalued debt levels. The Federal Reserve Act doesn't allow the Fed to buy corporate bonds, and yet the Fed bought corporate bonds this year. How did the Fed do that? They worked with the Treasury and Congress, set up a special purpose vehicle, and bought corporate bonds through that vehicle, with any defaults on those bonds funded by the Treasury, so the Fed doesn't face the risk of nominal losses. People saying this violates the Federal Reserve Act are, unfortunately, falling on deaf ears. Look, everyone, the Fed's buying corporate bonds. See? Nobody cares. Policymakers went around the spirit of the Federal Reserve Act, but perhaps not the letter of the law, due to the structure involved. It's perhaps not surprising that the heads of the world's 2 biggest central banks The Fed and the ECB are both lawyers rather than economists. I personally think that the Fed buying corporate bonds was not a good part of the overall policy response and sets a bad precedent and moral hazard. But it happened nonetheless. And it is during the apexes of long-term debt cycles that these sorts of exceptions tend to happen. This is a good time to bring to light that Lynn Alden is heavily influenced by Ray Dalio's research on the long-term debt cycle, and she has admitted it in a multitude of different vlogs or podcasts that Dalio's introduction to the long-term debt cycle has helped her develop her macro view. The Fed has legal limitations on its own, which is good. However, when the Fed works closely with the Treasury Department and Congress to combine fiscal and monetary policy, all bets are off. They worked together closely in the 1940s decade to fund World War II in the second half of the previous long-term debt cycle apex, and did so again here in the new 2020s decade. Love it or hate it, that Treasury plus Fed combo is extremely powerful and bypasses just about any limitation that the Fed alone has. The Fed can lend but can't spend. The Treasury can spend, but if it spends a ton and issues more sovereign debt than there is demand for, it needs the Fed to buy some of its sovereign debt issuance using primary dealer banks as pass-through entities. The Fed can't buy certain securities, particularly those that could lead to nominal losses, but with a special purpose vehicle and a financial backstop by the Treasury, they can. Together, they can create new money and inject it to whoever they want. I have to reread this paragraph. This is very, very key. This is important. Love it or hate it, that Treasury plus Fed combo is extremely powerful and bypasses just about any limitation that the Fed alone has. The Fed can lend but can't spend. The Treasury can spend, but if it spends a ton and issues more sovereign debt than there is demand for, it needs the Fed to buy some of the sovereign debt issuance, using primary dealer banks as pass-through entities. The Fed can't buy certain securities, particularly those that could lead to nominal losses, but with a special purpose vehicle and a financial backstop by the Treasury, they can. Together, they can create new money and inject it to whoever they want. Many people think that the broad money supply is only able to increase when banks lend money and create deposits. However, ironically, the biggest increases in the broad money supply historically happen when things are terrible, and so banks aren't lending much, and thus when the money multiplier, broad money divided by base money, is low. I have to think about this. Many people think that the broad money supply is only able to increase when banks lend money and create deposits. However, ironically, the biggest increases in the broad money supply historically happen when things are terrible, and so banks aren't lending much. And thus, when the money multiplier, broad money divided by base money, is low. So I guess Lynn is trying to say that while, yes, banks, through the credit creation theory of banking, increase the broad money supply gradually over time by extending credit and thus creating money. In times of great stress, think World War II, think Great Depression, think now, the increase in broad money actually happens when things are terrible and the banks aren't lending, but when the government has to figure out a way to increase the money supply. I think I get where she's coming from. Oh, and she goes into it here. At those times, the federal government runs massive fiscal deficits. Okay, she explains it. And goes around the bank lending channel to either tax less from the economy or inject more money into the economy. Historically, they choose the latter. And finances its massive deficits by having the Federal Reserve create new bank reserves to buy a large chunk of its treasury debt issuance. Well fucking done, Lynn. Good job. This chart highlights that by showing the money multiplier on the left axis with federal deficits as a percent of GDP and year-over-year percent increase in the broad money supply on the right axis. Okay, I even think that I agree. Man, data though, right? However, when it comes to investment timing, sometimes focusing on the mechanics is helpful, so let's dive into some of those mechanics. Bank reserve accounting. Bank reserves, referring to the accounts that commercial banks have with the Federal Reserve, are strange beasts because of how unintuitive they are. In fact, even the very definition of money is subject to debate. There are multiple ways to define money in the modern banking system. The monetary base and the broad money supply are the two most important definitions, so let's quantify them for context. Base money. The monetary base is the foundation and consists of physical currency in circulation, currently around $2 trillion, and cash reserve deposits that the commercial banking system has with the Fed, currently around $2.8 trillion. Although not part of the original definition, because the Treasury's General Account, the TGA, with the Fed has grown in size and importance in recent years, currently $1.7 trillion, we functionally should include that as well, since it's another cash deposit with the Fed. Those three buckets combined are $6.5 trillion in base money. All three of these buckets of base money, currency in circulation, physical money, bank reserves with the Fed, held by the commercial banking system, and the Treasury General Account with the Fed, are the Fed's biggest liabilities. On the other side of the Fed's ledger, Treasuries and mortgage-backed securities represent most of the Fed's assets. If we look at these major Fed liabilities separately, with the TGA in blue, bank reserves in red, and currency in circulation in green, it looks pretty random. However, there's a method to the madness, and the Fed controls the total sum. The next chart shows the sum of those three lines, meaning currency in circulation. Commercial bank reserves with the Fed and the Treasury's general account with the Fed, which are collectively the main liabilities of the Fed in blue, and shows the total assets in red, which consist mostly of Treasuries and mortgage-backed securities. I figured that these were going to line up pretty closely. Bank cash reserves at the Fed are fungible with each other. As folks like you and I use various payment systems to transact with one another, our banks use reserves to settle with each other behind the scenes. I agree. Bank reserves are also fungible to some extent with currency in circulation. In fact, that's one of the initial reasons for banks to have reserves in the first place, in case tons of people want to withdraw money at once. In theory, if we all wanted to go and take out some of our bank cash at once, it would come from bank reserves. However, in practice, the amount of minted physical currency is limited, mostly on purpose, so if there was a bank run, consumers would quickly find themselves limited in how much cash they would physically be allowed to withdraw as the bank runs out of vault cash. But basically, physical currency and bank reserves are fungible. I even agree with this. Bank reserves are fungible with the TGA account as well. When the Treasury issues a lot of bonds and pulls capital into its account, it sucks out bank reserves. When it eventually spends down its account, those funds wind up back in bank reserves. The broad money supply, on the other hand, is currently 18.8 trillion, which is by far larger than the base money amount. This broad money calculation consists of currency in circulation, but then also includes the massive amounts of checking deposits, savings deposits, and various functional cash equivalents that consumers and businesses hold at commercial banks. This is the broader set of money that we consumers actually use to transact with each other and store our capital and define as our money. The blue line below shows the broad money supply. The red line shows commercial bank deposits, and the green line shows physical currency in circulation. The red line and green line added together roughly equal the blue line. Okay, I get this. When the Fed does QE alone, it increases bank reserves in the system, but doesn't necessarily increase the broad money supply. The broad money supply only increases when either A, banks create more money by making loans, or B, the federal government runs big fiscal deficits to inject more money to people and businesses in the system. Many people miss that second one. They assume that money supply can only increase if banks lend, which is not correct. I'm going to read that one more time. When the Fed does QE alone, it increases bank reserves in the system, but doesn't necessarily increase the broad money supply. The broad money supply only increases when either A, banks create more money by making loans, or B, the federal government runs big fiscal deficits to inject money to people and businesses in the system. Many people miss that second one. They assume that money supply can only increase if banks lend, which is not correct. conservation of reserves plus currency plus the Treasury General Account equals the base money. Or I'm sorry, base money. For the most part, only the Fed can determine the sum of commercial bank reserves plus currency in circulation plus the Treasury General Account, hereby referred to as base money. Think of these three forms of base money as buckets of water. The total amount of water can be moved around between the three buckets if we pour one into another, but is conserved within the total three-bucket system. Only the Fed can increase or decrease the total amount of water in the total three-bucket system. Commercial bank reserves plus currency in circulation plus Treasury's general account. The purpose of modern banks is to multiply base money into broad money. Okay. The purpose of modern banks is to multiply base money into broad money and make a profit along the way. We can call this the money multiplier, defined as the broad money supply divided by the base money supply. When a bank makes a loan to someone, it becomes another bank's deposit, and the loaning bank sends the reserve amount to the depositing bank and increases the total amount of commercial bank deposits and broad money in the system. So, when they quote loan reserves, quote, banks collectively don't actually reduce total bank reserves in the banking system, they just lever those reserves up with a higher money multiplier and change the location ownership of those reserves. Any bank can leverage itself up to a limiting point where it still meets capital and reserve requirements by lending money or buying securities, and thus reducing its excess cash reserves at the Fed. However, when they make these loans or buy those assets, they create deposits somewhere else in the financial system, and those deposits become reserves of other banks. Similarly, a bank could sell assets and increase its cash reserves, but in doing so, some other bank deposits would be drained to buy those assets, which would reduce reserves somewhere else in the system. Therefore, the banking system as a whole can't decide to collectively increase or decrease the system-wide amount of bank reserves, even though any individual bank can alter its own level of reserves. They can collectively increase the money multiplier, the broad money supply divided by base money, by making more loans or buying more securities, but they can't change the total system-wide bank reserves. They can just move them around and leverage them up or deleverage them. Similarly, the United States Treasury can determine the size of its general account at the Fed. To increase it, they can issue treasuries, bringing in a lot of cash, and then holding the cash in that account at the Fed for a while before spending it. This sucks bank reserves out of the system on a one-to-one basis with the general account increase. When they eventually reduce the general account by spending more than they take in, that money goes into people's and companies' bank accounts and thus winds up back in bank reserves. The public can theoretically pull money out of excess bank reserves into physical currency or deposit physical currency into banks, which would wind up as more reserves, like water flowing back and forth between those two buckets of base money. However, in practice, physical currency is limited on purpose, So if the public collectively tries to pull bank reserves out into physical currency, they get told by the bank teller that they can't because there's a nationwide shortage of physical currency. The Fed, however, can create new base money and thus more total water into the three-bucket system analogy by performing quantitative easing, or QE. To do this, they create new bank reserves out of thin air and then buy existing assets like treasuries or mortgage-backed securities with the new reserves. After the asset swap, the reserves become owned by a commercial bank and thus become the Fed's liabilities, and the securities become owned by the Fed and thus become the Fed's assets. In this process, the Fed increases their total assets, the securities they are buying, and increases their liabilities, the new reserves they are creating, by the same amount. The Fed can also decrease base money or destroy water in the three-bucket system analogy by performing quantitative tightening. To do this, they sell or let some of their treasuries or mortgage-backed securities mature and get their principal back. They then retire that cash. In this process, both the Fed's assets and liabilities decrease. In a vacuum, neither quantitative easing or quantitative tightening alone directly affects the broad money supply. It just affects the base money amount. However, if the federal government is running very large deficits and the Fed is creating new bank reserves to buy the Treasury issuance to fund those deficits, it directly creates new broad money and thus goes around the bank lending channel. On the other hand, if the federal government were to run big fiscal surpluses on a sustained basis, tax more than they spend by a lot, at a time when banks aren't lending much either, they can theoretically decrease the total amount of broad money. This would be very rare, if ever, to occur. Additionally, widespread bank collapses without any bailout or FDIC insurance can also theoretically reduce broad money, which happened in the early 1930s. This article was written by Lynn Alden of lynnalden.com. You can also find her work at Lynn Alden Contact on Twitter. Bank reserve accounting examples. This section gets gritty. Shout out, Philadelphia. Quantitative tightening was done once from 2018 to 2019, which in my opinion led to the repo market seizure in September of 2019. So there was a $300 billion attempt of quantitative tightening in that small window, which in my opinion took too many reserves out of the commercial banking system and led to the overnight repo spike. So to me, here from February of 2018 into August of 2019 was an attempt of quantitative tightening, yet they immediately had to reverse it and inject liquidity back into the reserves because they were seizing up the markets. So never successfully done, I would agree with. Bank reserve accounting examples. A person in my live chat just said, this is an ultimate source to refer back to. My stream title for the day is Banks Quantitative Easing and Money Printing, the Definitive Paper. I really truly believe that this is, at the moment, the best paper that I've ever read about these topics. I can't think of one that has really been this accurate so far. Bank reserve accounting examples. This section gets gritty. I'll work through 6 examples of bank lending, quantitative easing, and fiscal deficits to help show which types of actions by banks, the Fed, and the government can influence the amount and location of bank reserves and broad money supply in the system. For each example, I have 2 people, Mary and Sarah, the 2 banks they do business with, the Fed and the U.S. Treasury. Each of the 6 entities has a column that represent each of their assets and liabilities. Each example is a small, closed-loop financial system. Each block in an entity's asset or liability column represents $1,000 of value. D represents a $1,000 customer bank deposit. R represents a $1,000 cash reserve allocation that a bank has at the Fed. T represents a $1,000 U.S. Treasury note, United States federal government debt. Other assets, like a 1,000 used car C or a 1,000 car loan L, are sometimes used as well. A deposit block D is an asset for a consumer and simultaneously a liability for their commercial bank. Since the bank holds it on behalf of the consumer and owes it to them on demand. Similarly, a reserve block R is an asset for a commercial bank and they keep it at the Fed. The Fed lists it as a liability owed to the bank who deposited it with them. Likewise, a Treasury note T is an asset for whoever holds it, whether a consumer, commercial bank, or the Fed, and is a liability of the United States Treasury. A bank loan block L or mortgage block M is an asset for the bank that lent it and a liability for the consumer who borrowed it from their bank. Example 1. A bank loans money. This is the simplest example to show how banks create deposits and broad money without reducing the amount of reserves in the system. It involves Mary buying a used car from Sarah. Here is the visual with a beginning, intermediate, and ending state, and a description afterward, so you can go back and forth between the visual and the description. Okay, so deposit, reserve, deposit, car loan, reserve, treasury, deposit, treasury, reserve. Okay, oh geez. Okay, so Mary, who is buying the car from who? Mary buys a car from Sarah. So Mary makes a deposit, and Mary's bank has her deposit as a liability and then has reserves with the Fed. Sarah has deposits, which are her assets. Sarah's bank has her deposits as liabilities, and Sarah's bank has reserves, which are liabilities of the Fed. Sarah's bank holds treasuries, which are assets of the Fed, liabilities of the Treasury. So that's the beginning. Bank loan intermediate state. Mary takes on a liability of a loan. Mary's bank has her loan as an asset, has her deposits as liabilities. Sarah begins with assets of the car and her deposits. The bank loan end state then goes as follows. Mary's assets are now the car and her deposits, and her liabilities are her loan. Mary's bank's assets are the reserves that are held by the Fed and the loan that Mary has with the bank, while Mary's bank liabilities are Mary's deposits. Sarah now has cash monies, a lot of deposits, which are liabilities that her bank holds for her. Sarah's bank has reserves, which are liabilities at the Fed. The Fed's assets are the treasuries, which are the liabilities of the United States Treasury, and the assets of Sarah's bank. Mary begins with D in assets, meaning a $1,000 deposit in her bank and no liabilities. Her bank, which is very unlevered, starts with her deposit D as a $1,000 liability, and then has two reserve block assets, R, representing $2,000 held at the Fed. Sarah begins with DDDC in assets, meaning $3,000 in bank deposits at her bank, and a $1,000 used car, and no liabilities. Her bank starts with her deposit, DDD, as liabilities, and has its assets primarily invested in treasuries, triple T, and one reserve block at the Fed, R. The Federal Reserve holds the three blocks of reserves from the two banks as its liabilities, and has three blocks of treasuries as its assets. Quick aside to what some of the people in my channel are talking about. Larry, I cannot answer your question. I don't know the answer. And the conversation about is this taught in K through 12? I took statistics, geometry, trigonometry, functions, calculus 1, calculus 2, calculus 3, of which was AP, Calc 1, and then BC. So I took like AB and BC calculus. There were no economics courses offered at my high school whatsoever. No economics courses. I took street law, I took American legal systems, I took AP history, I took AP French, I took AP physics. We did not offer an economics course, to the best of my recollection. And I went to a pretty good public school. I went to a very good public school. The Federal Reserve holds the three blocks of reserves from the two banks as its liabilities and has three blocks of treasuries as its assets. The banks use the Federal Reserve as their bank in a similar way that Mary and Sarah use their banks. In other words, the two banks store their extra cash reserve assets in their accounts at the Fed, which are the Fed's liabilities. The United States Treasury Department, representing the financial arm of the overall United States federal government, has 6 blocks of treasuries outstanding as its liabilities. For the sake of simplicity, it doesn't have any assets listed, but in reality its assets would consist of working capital, various federal buildings, lands, military assets, and its ability to tax citizens. Its 6 treasury liabilities are owned by the Fed and Sarah's bank. Between Mary and Sarah's cash, there are 4 deposit D blocks in the total system, which are assets for them and liabilities for their banks. Likewise, there are 3 reserve R blocks in the system, which are assets for their banks and liabilities for the Fed. If you're still watching this video on YouTube, I think we've mostly gotten through the parts that I was interested in reading the paper for. Now I think it's going to be more of these explanations. And this is going to be very boring to get through. Lynn, your work is excellent. I'm not looking forward to the next hour of going through this. Now, for the intermediate state. Actually, I'm gonna skip this one. I'm not as interested in knowing how one person sells a car to another. This part is not as needed. I am interested in example 2. The Fed performs quantitative easing from banks. The next example is a bit more realistic, with a more levered banking system. It involves the Fed performing quantitative easing on the banking system. Meaning it creates new reserves to buy existing assets from the banks. I'll just show the beginning and end step here and skip over the intermediate state. Okay, so at the beginning, Mary's assets are a house, a car, and $4,000 of deposits. Her liabilities are the car loan and the mortgage. Mary's bank has assets of $1,000 of reserves, $2,000 of treasuries, $1,000 of a mortgage, and $1,000 of a car loan, with liabilities of 4 $1,000 deposits from Mary. Sarah has the same that Mary has. And then the Federal Reserve has 2 assets of treasuries, 2 liabilities of reserves, and the Treasury has all liabilities of treasuries. The end state is... Okay, I get this. Okay, so before, the Mary's bank only had $1,000 in reserves, and Sarah's bank only had $1,000 in reserves. But the QE alone end state involved the Federal Reserve creating more reserves as their liabilities to purchase the mortgages from the banks, moving them from the asset side onto the Federal Reserve's asset side, and capitalizing Mary's bank and Sarah's bank with reserves. That's easy enough to understand. Sarah and Mary are both identical to each other in this example. For assets, they each have a house, H, or car, C, and $4,000 in deposits at their banks. For liabilities, they also have a car loan, L, and a mortgage loan, M, owed to their respective banks. The banks are also identical to each other in this example. Okay, we got that part. The Fed is small with just RR in liabilities for their member bank reserve accounts, one for each in TT and assets. The Treasury has 6TTT or 6T in liabilities, which are owned by the banks and the Fed. There are 8 deposit blocks in the system and 2 reserve blocks, so the system money multiplier is levered at 4 to 1. In the end state, in this example, the Federal Reserve realizes that both Mary's bank and Sarah's bank just have 1 reserve block each. Assuming the banks are each required by regulations to have at least 1 reserve block, this means they really can't lend any more and can't create more broad money. The Fed wants banks to be able to lend, so the Fed decides to recapitalize the banking system by giving them plenty of excess reserve blocks. It can't, however, legally just give free money to banks. It has to take something in return. The Fed creates 4 new reserve blocks out of thin air and gives 2 to Mary's bank and 2 to Sarah's bank. These new reserve blocks become liabilities of the Fed and become assets for the banks. In return, the Fed takes 1 mortgage block and 1 treasury block from each. The Fed therefore adds TTMM to its assets and RRRR to its liabilities. The banks are now much better capitalized, with plenty of excess reserves as assets and fewer treasuries and mortgages. If they want to loan money or buy more securities, they now have plenty of excess reserves to do so with. However, they haven't lent any more money yet, so the amount of deposits or broad money in the system remains unchanged. Underneath the surface, the banks are just less leveraged, with plenty of reserves relative to deposit and liabilities and overall assets. Mary and Sarah didn't notice anything from beginning to end. They had the same assets and liabilities. They weren't even aware it happened. The Fed is now more leveraged, with more assets and liabilities than they started with. The United States Treasury didn't change on net, except that it now attributes ownership of 2 of its Treasury note liabilities to the Fed instead of to the private banks. There are still 8 deposit blocks in the system, but the number of reserve blocks has increased from 2 to 6. So the money multiplier in the system is now 8 to 6, aka 1.33 to 1. The amount of broad money has not changed, but the amount of base money grew. Well done. Due to the Fed's decision to buy bank assets with new reserves, the banking system has now been recapitalized and it has a lot more lending power. This is why, although many people think quantitative easing by itself is inflationary on consumer prices, it generally is not. The money isn't getting out to consumers like Mary and Sarah yet. It's just internal to the banking system. This quantitative easing process sets the long-term stage for inflation as an early foundation by recapitalizing banks and therefore being anti-deflationary by preventing a bank collapse and ensuring they have plenty of lending capacity. But it's not inflationary yet. Inflation would come if Mary and Sarah have a lot more deposit money chasing the same amount of goods and services, but neither Mary nor Sarah have more deposit money than they started with, and there's no reason for anything to be inflationary. The amount of consumer deposits in the system has not changed. Example 3. The Fed performs QE from non-banks. The third example starts with a simpler system again, very similar to example 1. However, instead of having a car as an extra asset that she had in the first example, Sarah has a treasury note. Sarah decides to sell her treasury note, but there aren't many buyers for it at the moment, so the Federal Reserve steps in and performs QE to buy it from her. The result ends up slightly differently compared to the Fed buying a treasury from the banking system. Has this ever really happened? Has the Fed ever done QE from non-banks? I don't know if this has ever happened. Everything begins similarly to example 1, except Sarah has the treasury note instead of a car. There are 4 D deposits in the total system and 3 R reserves to start. Sarah decides to sell her treasury note, but neither Mary nor either bank want to buy it, so the Fed decides to buy it. The Fed creates a new bank R out of thin air and gives it to Sarah's bank, and tells the bank to buy Sarah's treasury note with a new deposit, and then give it to the Fed Treasury T. The Fed, therefore, bought Sarah's treasury note with a brand new reserve block, using the bank as an intermediary, so Sarah and the Fed never spoke with one another. Sarah sold the treasury note to her bank for a deposit block, and her bank sold it to the Fed, who bought it. After the bank completes this task, Sarah has the same net worth as she started with, but replaced her treasury with an extra deposit. Her bank also has the same net worth, but grew a bit bigger with an extra reserve, an extra deposit block liability to Sarah D. The Fed grew a bit more leveraged as well, with an additional treasury asset and an additional reserve liability, which it lists as an asset of Sarah's bank. The treasury didn't change on net, except that it now recognizes Sarah's initial treasury T, owned by the Fed instead of Sarah. Whether this is stimulatory for the economy or not depends on what Sarah does with her extra cash. She had DDDT before, and now she has DDDD. So instead of having $3,000 of green dollars and $1,000 of yellow dollars, green being deposits, yellow being treasuries, she now has $4,000 of green or deposits. It's still $4,000, but it's a bit more liquid. Okay, so there, yeah, liquid. If the reason for her selling the treasury was to raise more cash to do something big, like start a business or lend money to her friend to start a business, then it might be stimulative. However, if she merely holds it, then she's not using it any differently. It then becomes a question of what her bank does. Sarah's bank now has an extra reserve asset block liability compared to the beginning state, meaning it's a bit bigger and has more lending power. It could finance a corporate loan or a consumer loan, which would be stimulative, or if it thinks the economy is too risky, or if none of its creditworthy corporate or consumer clients are asking for a loan, it might just sit on its safe double R triple T assets and do nothing. In that case, the example would not be stimulative. There are now $5,000 worth of deposits in the system compared to the beginning state that only had 4. In addition, there are 4 R reserve blocks when it only had 3 at the beginning. So there's more liquidity in the system, with an increase in both base and broad money. However, none of the broad money has been moved yet, and is just sitting there with Sarah and her bank. Broad money velocity is low, in other words. There's more inflationary potential in the system due to there being more broad money in reserves, but no consumer price inflation yet. Sarah is not any richer, just slightly more liquid. In this example, the Fed directly increased the amount of broad money in the system without banks doing any private lending and without the federal government doing any spending, but it remains unclear if it'll be impactful or not, subject to what Sarah and or her bank do with the extra liquidity. Even if it is impactful, the Fed wouldn't be able to repeat it a second time because neither Mary nor Sarah have any more treasuries. If anything, it's likely to be somewhat inflationary on asset prices because Sarah is flush with cash and perhaps more willing to buy stocks or more treasuries. She's a saver, and this might not make her spend more, but it might shift how she invests with extra liquidity. We are about an hour and 45 minutes into reading this paper. The paper was written by Lynn Alden. Lynn Alden contact on Twitter. And you can find Lynn's work at lynnalden.com. Example 4. Non-bank financed helicopter money. The first 3 examples were separate cases, each meant to illustrate a different scenario. These final 3 examples, example 4, example 5, and example 6, build on top of each other to show what happens when the Treasury gets involved with deficit spending, with differences depending on who finances that spending by buying the Treasury debt. Example 4 begins with a relatively unlevered system. However, the economy is in recession, and Mary just lost her job and only has a little bit of money in her bank account and is making her frustration known. So Congress authorizes the United States Treasury to send everyone $1,000 in stimulus checks right to their bank accounts. This is known in economics as helicopter money, referring to a thought experiment of dropping money out of helicopters on consumers. The Treasury finances this by issuing Treasury bonds, which Sarah, who has plenty of money and hasn't lost her job, buys. Helicopter money, beginning state. Mary only has $1,000 in deposits. She has a car loan, so Mary is broke. Her loan is $1,000. She only has $1,000. But Sarah is rich as fuck. Sarah's got $3,000 and no liabilities. Helicopter money end state. Mary got airdropped $1,000, which end up as a liability of Mary's bank. Sarah bought the Treasury that was required to be sold in order to drop the money into Mary's account. There are now more liabilities at the Treasury, of Treasuries. Beginning state. Mary has a car C and a deposit D as assets and a car loan L as a liability. Mary's bank has a reserve block R and Mary's car loan L as assets, and has Mary's deposit D as its liability. Sarah has 3 blocks of deposits DDD as her assets and no liabilities. Sarah's bank has a blend of excess reserves and some treasuries as assets, RRT, and has Sarah's 3 deposits as the liabilities. The Fed holds the 3 banks' total system reserve blocks as its liabilities and holds 3 treasuries as its assets. The United States Treasury has 5 Treasury notes outstanding as liabilities which are owned by the Fed and Sarah's bank. Total system deposits are 4D4000, and total system reserves are 3R equaling 3000. Intermediate state not shown. Although it is the originator of the currency, the United States federal government legally has to finance its spending by receiving taxes or issuing Treasury debt to settle its account. Agreed. So the Treasury sends a $1,000 deposit block to both Mary and Sarah, deposited into their bank accounts. Both Mary and Sarah are happy because their net worth goes up by $1,000 each. Their banks get money deposited into them and haven't loaned any out yet, so they keep the new cash at the Fed as new reserves. However, this is just a brief intermediate state. The Treasury now issues new Treasury note liabilities, TT, to pay for the expenditures. Sarah then decides to use 2 of her deposit blocks to buy those 2 Treasury securities, since they are yielding slightly higher rates than her bank deposit account yields. If we imagine it happening simultaneously, what happened is that the United States Treasury extracted 2 deposit blocks from Sarah, and therefore extracted 2 reserve blocks from Sarah's bank, as Sarah's bank settled the transfer with the United States Treasury. And the United States Treasury gave Sarah 2 Treasury note blocks as assets in return. At the same time, the United States Treasury gave both Mary and Sarah 1 deposit block each, and therefore gives 1 reserve block to Mary's bank and 1 to Sarah's bank to settle the transfers. By the end of the transfers, both Mary and Sarah are $1,000 richer than they started. Mary's assets went from CD to CDD, and she gained a deposit block. Sarah's assets went from DDD to DDTT because she gained a deposit block but used 2 to buy treasuries. Mary's bank is slightly bigger than it began because Mary received a deposit block and her bank was credited with a reserve block to settle it, but also owes an extra liability in $1,000 to Mary, and Mary has not spent it yet. So Mary's bank has the same net worth in assets and liabilities, but its overall combined assets and liabilities are bigger, and it has more lending power because of that. Sarah's bank is slightly smaller than it began, because although Sarah and her bank received a deposit and reserve block respectively, Sarah sent 2 deposit blocks to the Treasury to receive the Treasury notes, and therefore Sarah's bank sent 2 reserve blocks to the Treasury, which were then given back out, 1 to Mary's bank and 1 to Sarah's bank. Sarah's bank has the same net worth but is simply smaller, as both assets and liabilities decreased, and its lending power is decreased. The Fed is unchanged, except that it updated its bookkeeping to attribute 1 of the reserve blocks R to Sarah's bank instead of Mary's bank. Its overall amount of Treasury note assets and reserve liabilities remains unchanged. The Treasury is more leveraged, with an extra TT in debt, liabilities, and outstanding owed to Sarah. Total system deposits are 4D, 4,000, and total system reserves are 3R, 3,000, meaning that neither the total amount of deposits or reserves changed in the system from the beginning state to the end state. Deposits and reserves were just moved around a bit within the system. So I don't think that this is really how it happens. From my analysis, I don't think they've really done it this way. Okay, from my analysis, example 4 does not explain 2020 helicopter money. Example 5 is probably going to explain 2020 helicopter money. What's example 6? Bank financed helicopter. Okay, so yeah, I'm imagining 5 is going to explain 2020. Fed financed helicopter money. No, it's not off. It's correct. It's just explaining something that doesn't happen. That's all. It's it's just 6 different examples of way things can go, but 4 just doesn't happen. Well, I mean, 4 is what probably happens during normal times, because you have the prime dealers sell the treasuries to the secondary market. But so 4 explains normal economic times in my kind of way. So like when the treasury runs deficits and sells treasuries to the prime dealers sell them to people like Sarah. So during normal economic times, deficit spending is non-bank financed, quote unquote, helicopter money. But I'm talking about like public investments, not depositing money directly into a person's account. So this kind of I'm just going to leave it there. I think that I understand it, and I think once we read 5, it'll answer some questions. Fed financed helicopter money. Example 5 starts exactly where 4 left off and builds from there. Mary and Sarah are happy because they got extra money. However, Sarah is prudently saving her money due to uncertainty about the economy, and Mary doesn't have a job, and she's just saving the money. And their favorite restaurants and vacation spots are closed due to a virus pandemic anyway. Some politicians want to give $1,000 to everyone every month for the next year, due to so many displaced workers like Mary having so little money with no jobs. Others say, no, it's too much federal debt, let the economy try to heal itself. The politicians argue for a couple months. They eventually compromise and send everybody $1,000 one more time to see if it helps. So the Congress authorizes the Treasury to send out $1,000 to everyone. This time, instead of Sarah buying the new Treasury liabilities with her existing deposits, the Fed buys the new Treasury liabilities with the new reserves. So this is what would be called monetizing the debt. So the Treasury gets sold to the primary dealers, then the primary dealer sells it back to the Federal Reserve, is what I'm imagining this is going to look like. Yeah. Okay, so Mary starts off with $2,000, Sarah starts off with $2,000. Then they each end up with $3,000. There's $3,000. But there was no commercial bank or private citizen to buy the treasuries, so the Fed had to monetize the treasuries or monetize the debt. So that's where you get the Federal Reserve asset side adding 2 more treasuries. So they add in they buy them from the banks. So they sell the treasury to the bank. Then they immediately buy the treasury back from the bank, which is why each of the banks has an extra reserve. So the bank started with $2,000 in reserves and $1,000 in reserves. Then they finish with $3,000 in reserves and $2,000 in reserves because they only very, very, very temporarily held the treasuries. I think that's where Lynn's going to go. Sarah already owns a lot of Treasury notes and sees the U.S. Treasury will become even more indebted after it sends out all the money without raising taxes, so she doesn't want to buy any more treasuries. So how will the Treasury finance the second round of helicopter money? Well, because there's a lot of new Treasury note issuance, but nobody desiring to buy it at current prices, the Treasury note market suddenly becomes illiquid, and prices start to fall, meaning yields begin to rise. Sarah and her bank both get nervous because they own treasuries. The Treasury note market briefly looks like it did in March 2020, totally illiquid, with yields extremely volatile. However, the problem didn't last long because the Fed says, it's fine, we will buy the Treasury note issuance, relax. So the Fed creates 2 new bank reserve blocks, R, and gives them to the Treasury in exchange for the new Treasury liabilities, T's, which become the Fed's assets. Technically, the Fed can't legally buy directly from the Treasury, so they agree to transfer the securities through one of the banks as a brief pass-through entity, like I thought it was going to end up being. The United States Treasury then sends a $1,000 deposit to each Mary and Sarah and settles this by adding a reserve block R to each of Mary and Sarah's bank accounts. Mary and Sarah are both $1,000 richer again. They each have a new $1,000 deposit D. Mary and Sarah's banks are both bigger, although their net worth did not change. They each have an extra $1,000 reserve block, but they each have a new $1,000 liability block to the consumer D. The Fed is bigger and more levered, with $2,000 more assets in the form of treasuries, TT, and $2,000 more liabilities in the form of reserves, RR, that they hold for the banks. The Treasury is bigger and more levered, with 2,000 TT and more debt liabilities outstanding. System-wide deposits, broad money, increased over the beginning state from 4 to 6. System-wide reserves also increased from 3 to 5. This was outright money printing. The amount of broad money and base money in the system went up by a lot. Mary and Sarah are richer and their banks are bigger. Money injected into the system without being extracted anywhere from the system because the deficit spending was financed by the Fed, creating new bank reserves to buy the Treasury notes. The Treasury and the Fed can perform this repeatedly if they want, any number of times, although they both know that if they do it too much, it would cause CPI. Whether it is inflationary for consumer prices or not, however, it depends on whether Mary and Sarah still have confidence in the value of their deposits and whether they go and spend them or not. It's also potentially inflationary for asset prices. Sarah, in particular, is flush with assets and more likely to put some money to work in stocks, gold, or other assets than she was before. And finally, example 6, bank-financed helicopter money. Interesting. The pandemic eased a bit. Mary got a job, but realizes she needs to keep more cash on hand in case she loses her job again in the future. She learned a lesson about saving, in other words. Sarah was already a saver and hasn't been spending extra money either. Sarah, however, is considering going on a vacation or buying a car now that she feels a bit more confident with so much cash. She's also not sure about the value of her money as she watches the broad money supply expanding so rapidly that everyone is receiving. Car prices are starting to go up, probably due to many people receiving stimulus checks, so there seems little reason to wait. However, because the economy is still sluggish, with many people saving more than they used to, Congress decides to do another round of $1,000 checks to everyone and issue new Treasury note liabilities TT to pay for it. This is the final stimulus round. Fortunately, the banking system has tons of excess reserves due to their previous round of helicopter spending that the Fed bought, so this time the banks each agreed to buy one Treasury note with one of their excess reserve blocks. In fact, the banks don't have much of a choice because primary dealers have to buy the Treasuries. Okay, so now the banks are actually buying it. This is how it's supposed to happen, but it doesn't exactly happen this way. Car, $3K in deposits, loan, $3K in reserves, loan as the assets, $3K in deposits as the liabilities, $3K deposit assets, $2K treasury assets. Sarah's bank has to have $2K in reserves for the treasuries, $2K in treasuries, $3K in deposit liabilities. Fed has $5K treasuries, $5K reserve liabilities. Treasury has $8K treasury liabilities because there's a total of that many treasuries outstanding. In the end, in this scenario, the Fed is going to be removing reserves from Mary's bank and Sarah's bank. I thought they were going to be removing reserves and putting a treasury out there. I guess I got it wrong. We'll see. Here's what happens if we imagine the process happening simultaneously. The Treasury sends Mary and Sarah a deposit block, and their banks each a $1,000 reserve block to settle it. The U.S. Treasury then issues 2 new Treasury note liabilities to pay for it. The banks each send a reserve block to the Treasury in exchange for each of those Treasury notes. Mary and Sarah are again $1,000 richer. Their banks have the same amount of reserves they started with because they each received a reserve block R from the Treasury's helicopter deposits to their accounts, but since each bank also sent a reserve block R back to the Treasury to pay for the stimulus, they each ultimately received the Treasury note as an asset instead. They still have the same amount of reserve blocks they started with, but they each have an extra asset T, so they have an extra deposit liability D for their consumers, so they're a bit more levered overall. The Fed didn't change at all from the beginning, though it did some bookkeeping for the reserves moving around and ending back in the same place. Okay. In response to high inflation, the Fed's normal tool would be to raise interest rates. However, the U.S. Treasury debt is so high at that point, the Fed's ability to raise interest rates would be limited since it would result in an acute fiscal crisis, as rising Treasury debt interest eats up a large part of the fiscal budget. So either the Fed would have to let inflation run hot and inflate away part of the debt and keep creating reserve blocks to buy new treasuries, as needed to keep Treasury security yields low, which they did in the 40s, or the Treasury would have to restructure default on the central bank portion of the Treasury debt. So, The Treasury plus Fed combo has all the power to boost the broad money supply enough to cause a rising trend in inflation, but when they do with such a highly leveraged U.S. Treasury, they face consequences in their ability to constrain it. And finally, example, summaries, and findings. If we analyze all the examples, we see a few observations. Banks can create new deposits and increase the amount of deposits, broad money, in the system by lending. Lending creates deposits. This lending does not change the amount of base money reserves in the system, but it moves those reserves around from one bank to another and levers those reserves up. This is the money multiplier ratio. The ratio of broad money to reserves is simplified in these examples. Although the banks can create new deposits and increase broad money by lending, it is not money printing because the banks are simply making decisions regarding how much to lever themselves up relative to their cash reserves, and they are constrained by various regulatory standards for how much leverage they can have. The Fed alone has the power to create new bank reserves, and to therefore increase the amount of bank reserves in the system, base money, or more broadly, the total amount of water in the three-bucket system analogy. However, if it buys assets from banks, it doesn't directly lead to more deposits, broad money, being in the system. It delevers the banks and gives them more capacity to lend and create new deposits, broad money, but whether they will or not is up to them. On the other hand, if it buys assets from non-bank entities like Sarah, using the banking system as its intermediary, it can slightly increase deposits, broad money, in the system, but only to a limited extent, based on limited amounts of non-bank entities holding treasuries that they can sell. In this sense, it's very limited money printing. So that was example 4. On behalf of Congress, the United States Treasury can give more deposits to someone somewhere in the system, but deposits also get extracted back out of the system when non-bank entities like Sarah buy the treasuries that are used to fund the expenditure. So it doesn't necessarily create new deposits or reserves. This is what deflationists often refer to as the crowding out effect, which, yes, meaning that the United States Treasury can extract capital from somewhere in the economy and inject it somewhere else in the economy. If it runs large deficits and builds up federal debt, and it displaces non-bank capital that could have been used for something else, this is not money printing, since it just moves things around and levers up the Treasury. However, if the Treasury and the Fed work together, which is what they did with this year's QE plus fiscal de facto MMT, they can rapidly increase both the deposits of broad money and bank reserves in the system, base money, without extracting deposits from anywhere in the system. In this process, the Treasury injects money into the economy by spending, which creates new deposits, but instead of that money being extracted from deposits, the Fed finances or monetizes those new treasuries with newly created bank reserves out of thin air, and thus levers itself with additional assets, the new treasuries, and additional liabilities, the new reserves attributed to the banking system. It doesn't matter if the banks lend or not. The Treasury plus Fed combo goes around the bank lending channel by just giving people and businesses more deposits, broad money. This outright increases the net worth of Sarah and Mary and increases their banks, including broad money supply and bank reserves. But the bank's net worth remains unchanged and levers up both the Fed and the Treasury. There's no limit to the amount they can do this other than the fact that it would eventually be inflationary if done too much and too rapidly relative to the amount of goods and services and productive capacity in the economy. This is outright money printing, although there are some checks and balances since fiscal changes would have to be passed by Congress and signed into law rather than done unilaterally by the Fed. Additionally, if the United States Treasury injects money into the economy with large deficits and the treasuries to finance it are bought by a well-capitalized banking system, usually as a result of the Fed having already capitalized banks by creating excess reserves in the past, it also increases the deposits or the broad money and levers up the money multiplier. So that's what's supposed to happen when they sell the treasuries. This can be done quite a bit if banks start with excess reserves, because every time the federal government injects more money into the system, it creates more bank deposits, which replenishes the reserves that the bank spent buying treasuries, and thus gives the banks more ability to buy additional treasuries. This is mostly money printing, although to maintain leverage ratios, the banks need to start with plenty of excess reserves. If there is a lot of broad money added to the system, with both Mary and Sarah confident to spend, it could very well be inflationary. Plus, now that Mary and Sarah are richer than they started, they might feel more confident to take out a mortgage loan or business loan from their bank to buy a house or start a business. And their banks are more willing to lend it now because Mary and Sarah both have plenty of net worth and credit worthiness. This could very well be inflationary. There are proposals for central bank digital currencies, which, if enacted, may allow the Fed to inject money to consumer deposits without going through Congress. This would likely require an overhaul of the Federal Reserve Act and would substantially change the nature of the system. Some folks argue that this would be necessary for inflation to happen, but inflation can already happen within the existing framework through the combination of fiscal deficits and QE monetization of those deficits. The current framework requires Congress to go along with it rather than performed unilaterally by the Fed, and thus has checks and balances in the system. Finally, implications focus on broad money. It's fashionable to debate lately whether QE is inflationary or not, and whether central banks have run amok. However, for more fruitful results as it relates to analyzing inflation versus deflation and the associated impacts on various asset classes, investors should focus on fiscal spending, especially when it's combined with monetary financing to pay for it, monetizing the debt. Are major fiscal deficits happening or no? How big are the deficits relative to the deflationary backdrop? Excellent question. Who are the deficits targeting? Who is financing the deficits by accumulating the treasuries? And then look at what the broad money supply is doing, if it's going up or no, at what rate. Banks are already well capitalized. The big non-fiscal QE for bank recapitalization was done back in 04 to 14, 08 to 14. Now, with massive treasury debt in the system and interest rates at zero, fiscal authorities find themselves spending more and running larger deficits, with the Fed and the banking system buying the majority of the treasury note issuance. We have a division of fiscal and monetary powers, and only when the powers combine, like in the 1940s and again in 2020, where the treasury runs massive deficits and those treasury notes are accumulated by the Fed and the banking system, does it become outright money printing. It doesn't require any change to existing laws for them to do that. They use banks as pass-through entities and other structures as needed to do what they do. Quantitative easing alone, where the Fed buys existing assets mostly from banks, is simply anti-deflationary to recapitalize a banking system and fill it up with excess reserves. It's not outright inflationary because it doesn't directly increase the broad money supply. If the Fed buys existing assets from non-banks, it only increases broad money a bit around the margins. Meanwhile, large fiscal deficits funded by quantitative easing, the central banks monetizing deficit spending by buying any of the excess treasuries over the real demand for them, actually is pro-inflationary because it gets money directly into the economy, into the broad money supply, and can be done with no limit except for inflation that it would eventually cause when done to excess. Whether it takes the role of unfunded tax cuts or unfunded fiscal spending, if fiscal spending is combined with monetary financing, results in higher personal income for consumers like Mary and Sarah, and more broad money in the system, it's an inflationary force. If it then becomes a question of how big it is, how persistent it is, and what portion of the income spectrum it is targeting, given how highly leveraged the system still is, and how reluctant banks are to lend for the next several years as we head deeper into the 2020s and eventually move past the pandemic, navigating the inflation-deflation debate is going to mostly be a matter of watching how large or small the federal deficits are and observing who funds the deficits, example the Fed and the banking system, and to see if the broad money supply goes up more quickly than the deflationary forces that exist. This paper was written by Lynn Alden on November 8th, 2020, called Banks, Quantitative Easing, and Money Printing. You can find Lynn's work at lynnalden.com. You can find Lynn on Twitter at LynnAldenContact. Lynn is the founder of Lynn Alden Investment Strategy, fundamental investing with a global macro overlay, finance engineering blended background. In my opinion, this is the definitive paper that can completely explain, with me having about a 98 or a 99% agreement with everything that was written, what quantitative easing was in 2008, what it became in 2020. I think it's an excellent analysis of bank reserves, of the different ways that debt can be monetized. If you like this kind of work and you want to hang out live in the channel, I broadcast on twitch.tv/Touring News. You can find me on Twitter at Touring News 1, and there will be more content like this in the future. Share the video, comment down below if you liked it or you didn't like it, like, comment, and subscribe, do all that retweeting stuff, and I thank you very much.